Hello and welcome to this video on liquidity ratios. In this video, we're going to take a look at the current ratio, quick ratio, receivable and payable days, and also look at the working capital cycle. So what do we mean by liquidity? Liquidity means having the money, the cash, or access to the cash readily available to meet obligations to make payments. Liquidity ratios and working capital ratios show us how much we have in terms of current assets to pay current liabilities. Now, when we use ratio analysis, liquidity is based and measured on the assumption that the only sources of cash available are the cash in hand and the current assets that will be converted into cash during the normal business cycle. So it's a very short-term focus. We forget about the long-term assets, the potential loans that we could get, and we focus on what is the cash the company currently has, and also what are the current assets that we can quickly turn into cash. We forget about any long or medium-term sources of finance. We also assume that the only immediate payment obligations faced by the company are its current liabilities. So as well as forgetting about the long-term sources of cash, we also ignore the long-term debts. Liquidity ratios are focused purely on the short term. So liquidity ratios are important because even if a company has a lot of assets, if they have a lot of long-term assets, if they can't pay their debts as they fall due, they could be in trouble. If you have a company with some major assets, maybe a large ship or a large building, but it can't pay its wages, it can't pay its electricity bill, it maybe can't pay its water bill, then there's going to be trouble. The company may be insolvent, even if it has a lot of assets. So let's get started. Let's look at the current ratio. The current ratio is the ratio of current assets to current liabilities. So it's current assets divided by current liabilities. Where do we get these figures? Well, the amounts of current assets and current liabilities that we find in the statement of financial position at the year end may be used. You don't need to use the average values for the year. Some people suggest that the ideal current ratio is 2. So 2 to 1. €2 or $2 current assets for every $1 or €1 in current liabilities. This isn't always true, and in some industries, lower current ratios are normal. So it's important to assess these liquidity ratios, such as the current ratio here, by considering how they've changed over time. What is their pattern? Also consider the liquidity ratios of other companies in the same industry and in the same period. Now, the quick ratio, it's also known as the acid test ratio. This is the ratio of current assets excluding inventory over current liabilities. Why do we exclude inventory? Well, we assume that the inventory may not be readily saleable. You mightn't be able to convert it quickly into cash. If the company has built up a large stock of inventory, it might not be able to sell this quickly enough to pay the current liabilities. So the quick ratio, current assets minus inventory divided by current liabilities. Once again, you can use the amounts for current assets and current liabilities that you find in the statement of financial position, and it's not necessary to use the average values for the year. Now, this ratio is a better measurement of liquidity than the current ratio because sometimes inventory turnover periods can be very slow. A company may buy in some inventory, but it may not be able to sell it for a number of months. So inventory is often not a liquid asset. Some people suggest that the ideal quick ratio, the ideal acid test ratio, is a ratio of 1 to 1. So if you have current assets minus inventory, for every $1 of that, you have $1 of current liabilities. This isn't always true again, and in some industries they have lower quick ratios. And also it's important to consider this quick ratio, consider the acid test ratio by looking at the changes in the ratio over time and then compare it with other companies in the industry over time. Let's look at receivable days. This is also known as the average time to collect or day sales outstanding ratio. This ratio estimates the time it takes to collect payment from customers after the sale has been made. You can also describe it as the average credit period allowed to customers or the average collection period. So when a company makes a sale, how long does it take on average to get money in? Because a company may sell the goods on credit and wait for the customer to pay it. Sometimes this might be 30 days, sometimes it may be 60 or 90 days. And some places this could be cash. If you have a supermarket, customers will pay you cash. There will be very little credit sales. So to calculate the receivable days, you take the average trade receivables and you divide it by credit sales. And then multiply this by 365 to get how many days on average it takes. Trade receivables should ideally be the average of the receivables during the year. This is the average of the receivables at the beginning of the year and the receivables at the end of the year. But if you can't get those figures, then try and go for the receivables at the end of the year. This is also commonly used. Now, ideally, you'll use the credit sales figure for calculating this ratio, but if you can't get that breakdown, then you can just use the total sales for the period. Now, the average time it takes to collect money from credit customers shouldn't be too long. A long average time suggests inefficient collection of amounts due from receivables. But keep in mind as well the industry that the company is operating in. As I mentioned earlier, if you have a supermarket, you'd expect a very, very low ratio here. If you have an industrial supplier, they may have to wait 60 to 90 days to collect their money. A similar ratio to the receivable days is the payable days. This shows us how long it takes the company to pay its suppliers. So when our company here buys goods or services, how long on average does it take them to pay their suppliers? The average time it takes to pay suppliers can be calculated by getting the average payables and dividing that by the credit purchases and multiplying it by 365 to get the day figure. The trade payables should be the average value for trade payables during the year. This is the average of the trade payables at the beginning of the year and the trade payables at the end of the year. But if you can't get the average payables, then you can just use the figures at the end of the year. If you can't get the figure as well for credit purchases, just use the figure for cost of sales. Use that instead. You can get these figures from the Statement of Comprehensive Income. And finally, the working capital cycle. This shows us how efficiently an entity manages its receivables, inventory, and trade payables. It can also be known as the cash operating cycle, and it's the average time of one cycle of business operations. So this is from the time that suppliers are paid for the goods that they supply to the time that the cash is received from the customers of the business. The working capital cycle is calculated by getting the inventory turnover, that's the amount of time it takes to convert the raw materials into finished goods, and you get this figure in days. Then you take the figure for receivable days. How many days does it take for you to get the money from your customers? So you add the inventory turnover days to the receivable days, and then you deduct the payable days. So how long does it take your company on average to pay your suppliers? So the inventory turnover days plus the receivable days minus the payable days, and this will give you the working capital cycle or the cash cycle for the business. Ideally, we want to get a nice short figure for this. The working capital ratio should be monitored over time, so it shouldn't be allowed to become unreasonable in length, because this will indicate that there's more money being tied up in working capital. But if it's too small as well, there might be an underinvestment in working capital. But normally we like to see a shorter working capital cycle. So that's our video on liquidity ratios. Now keep in mind, liquidity ratios are more informative when they're calculated for individual companies instead of group companies. When they're calculated using the group figures from the consolidated financial statements, they're the average measures for all the companies in the group, and this may hide some of the weaker and poorer performers in the group. So ideally, if you can, calculate these ratios using the individual financial statements. Thank you for watching this video. If you'd like to see more videos like this, please visit chartereducation.com.